Good morning, everyone. On behalf of Kiran Advisors, I welcome you all to the virtual Financial Year 25 earning briefing of NICE's Financial Services Co. Limited. From management team, we have Mr. Amit Goenka, Chairman and Managing Director, Ms. Mridula Goenka, Executive Director, Ms. Sunil Maheshwari, Chief Financial Officer, and Mr. Manish Miller, Director of Communication. I will hand over the call to Mr. Amit Goenka for opening remarks. Over to you, sir.
Yeah, thank you very much, and good morning, everyone. Thank you, friends, for joining this call this morning. I'm going to request my colleague to play a quick recap video about our journey of 24-25. Okay, fantastic. Thank you very much, and I hope everyone was able to see the short clip.
Amit, sir, your voice is not clear.
It's not clear. Am I audible now?
Yes, sir.
Okay, fantastic. So thank you very much for joining us again, and happy to present the short clip that you saw on our milestone journey, which had some very, very defining moments in the history and for the legacy of Nisus Finance. As stakeholders, we're very proud to present to you the unprecedented journey that we've charted and are very excited about what holds in the future for ourselves. I extend a warm welcome to you, all our shareholders, analysts, and esteemed partners this morning. And it's my privilege to present to you our performance and the highlights of what has been a truly transformational period for our company. This year has marked a tectonic change in the evolution of Nisus Finance as one of the leading urban infrastructure finance and solution providers in emerging markets, not only in India, but cross-border in the UAE and the GCC markets. It has been marked by international expansion and consistent value creation. We are India's first listed fund with a strong focus on urban infrastructure in emerging markets. We've taken bold strides to reinforce our leadership position, increase our managerial bandwidth, and create significant infrastructure across our markets to tap into new avenues of growth, both in domestic and global markets. We began this financial year with a strategic goal to deepen our global footprint and broaden our scope of investments beyond our traditional markets. I'm happy to share that we have successfully established a formidable presence in the GCC, like you saw, with high recall and high amount of engagement with the broader markets, particularly in Dubai, to the launch of our DIFC registered fund. We have not only acquired two high value assets worth over $55 million, but have an extraordinarily strong pipeline of over $200 million under acquisition. These are not just transactions, these are strategic footholds into the heart of the region, which continue to deliver long term promise and engagement with broader stakeholders. Our new office in DIFC and near DIFC is fully operational with a team of 9 solid professionals with deep expertise in regional markets. On the capital mobilization front, in line with our objectives, we have had significant results. We have forged global partnership with one of the global leading banks, Houlihan Lokey, to raise funds for our India and UAE focused investment vehicles and have seen significant success with them. We have partnered with global banks like Bank Mondial France, who have sanctioned a credit line of over 150 million dirhams and extending, with advanced discussions with global financial institutions and local banks in the region. We are one of the first managers in the country to have got this kind of support at a fund level from local banks and local institutions. These developments are a testament to our strength, our vision, our strategy, as well as our past track record, and a confidence that global investors and investment institutions are placing upon us on our governance strategy and our team skills. What makes this year truly gratifying is the success that we've achieved across our investment portfolios with stupendous exits. You have read that we have exited from several large high value transactions across cities with over 21% IRR for our investors, earning a significant fee and carry in our favor. Across our funds, these exits not only reflect our ability to select the right opportunities, but also a knack for timing in executing high value strategies with precision. At the core of our business lies an integrated model that combines fund management with opportunistic transaction advisory services for capital seekers and partners. This synergy allows us to provide end-to-end solutions to our counterparties and our stakeholders, being developers and investors, while ensuring a diverse and recurring revenue stream both in India and overseas. Our total assets under management, as you will see, have increased by nearly 50%, marking a significant growth over last year, despite some of the headwinds that we saw in the last quarter. Our fund management continues to contribute nearly 70%. Our advisory continues to contribute nearly 70% of our revenues, with fund management and other income contributing 30% in line with our guidance. We will show that to you in a bit. Beyond financials and operations, in which we continue to show excellence and have great amount of recall, great amount of credentials and accolades, what defines NISIS today is our people and the culture that we built very carefully. We're proud to share that NISIS Finance is now today one of the top financial institutions in India, which is certified as a great place to work. This recognition reflects our deep investment and commitment within our workplace, which is built on trust, collaboration, and innovation. Our high performing team of over 45 professionals today, spread across India and Dubai, is the engine behind our achievements, which will continue to drive extraordinary growth in the future. Their commitment and capability continue to fuel our momentum. From a product perspective, we have now several fund pools, as we will be demonstrating, which have a significant corpus which is to be deployed this year and going forward. We have been rated excellent, which is the highest rating by Carriage for our fund management. Recoff continues to one of our fund continues to deliver on our profits on our promise with superior realized and expected returns. However, as we celebrate our achievements as an investment manager, as people who deal with our investors' capital, with the sentiments and in view of the broader markets, the macro trends, we remain mindful of the broader economic environment and global challenges from time to time. We have experienced volatility in the last quarter, as you're all aware, especially in the India markets, with some of the global repercussions of the US presidency and some of the other broader economic trends, which have created some amount of caution in terms of our need to deploy capital in haste. That's something we will never do. India's real estate sector, however, on a long-term basis, continues to be robust and is continuing to poised to grow at 18% CAGR over the next 20 years. UAE and Dubai, in particular, again has an extraordinary run and continues to show extraordinary momentum going forward with over $250 billion worth of transactions, which have already happened in the last 12 months. Now let us talk about our financial performance, and we'll start with the slide. Next. Okay, so NISIS today has the ability to leverage a very deep experience of over 10, 11 years, which is very unique to our ecosystem. There are very few fund managers in India of our stature, of our track record, and our capabilities and execution, which are today obviously therefore at the center of the market. We have the capability to expand multiple times as markets consolidate in our favor. We continue to deploy local market expertise and proprietary data to capitalize on emerging trends and deliver superior risk-adjusted returns. We are today recognized as one of the leaders in urban infrastructure finance, not just in India, but in emerging markets of the GCC. What happened?
The PPT is not visible.
Or is it casting now? Is it casting?
Yeah.
I can see it, yes. I'm already online. I'm also online. I can see it.
You can see.
Yeah, I'm online. That's all connected.
Okay.
Separately.
We can continue.
Okay, we continue to focus on our two main areas, which is fund and asset management and related transaction advisory services. I'm happy to report that we've had a reasonable growth in our AUM, standing today at close to 1572 crores of assets in FY25. As I mentioned, we've been awarded excellent rating by CareEdge Advisory, one of the highest ratings for fund managers in India. Recognizing our strong focus on diversified AI funds and asset management, we've also been rated one of the highest performing funds by Preqin for our funds, as we stacked up against global fund managers in the RE credit space with one of the highest ratings by Preqin, which has got a huge amount of attraction and a huge amount of gravity from global investors who are now queuing up to work with us. We're happy that we got listed on the SME exchange on December 11 and continue to focus on our performance with laser-sharp focus. To give you a quick snapshot, as we maintain, our fund and asset management continues to have 33% revenue contribution, with 67% coming from related transaction advisory. We currently manage about 5 funds, with one fund having fully exited, being REIT, with other funds currently under deployment, investment, and exits. Rezo is today one of the largest India domestic funds with a pooling vehicle in Mauritius, which is the India Opportunities Fund. It is looking to deploy over 2,000 crores in this coming year. Likewise, we have a pooling structure for Dubai, which has a DIFC fund called NISIS High Yield Growth Fund, which has got a pooling structure in GIFT City, which is the NISIS High Yield Growth Fund in there, and Global Opportunities. Obviously, on the back of these fund structures that we've been able to create post our IPO, we've been able to accelerate our journey both in India and the UAE in a very significant way. Our transaction advisory services have also commenced significant operations in the UAE with reasonable amount of revenues already coming in the last quarter itself. That includes financial advisory, structuring, asset monetization, and other structured credit solutions being provided to local players by our competent teams in the UAE. Next. Okay. Key milestones for 25: establishment of the DIFC office in Dubai with 8 to now 9 investment professionals to expand the GCC operations. Investment into our NBFC basis the IPO proceeds. accelerating the GIFT City feeder and creating new investments into that in a very, very short time of less than 9 months. We were able to get the license, we were able to set up the team, we were able to create the GIFT City structure, we were able to create new capital commitments in GIFT City, we were able to create new capital commitments in the UAE, we were able to get bank approvals, and we were able to buy assets. We've achieved in 3 quarters what we've typically seen people do in 2 years. So clearly, we have had a very significant momentum and a very laser sharp focus on this growth story for Nixus Finance in the UAE. Obviously, I mentioned we've retained one of the largest banks in the world as partners. We've got sanctions from one of the global banks for over $68 million, with another $200 million of bank sanctions already underway, making the total bank debt sanction for the fund at about $268 million. We have almost already $200 million of commitments now under closure from global funds who are looking to participate in a UAE fund, thereby taking the total deployable corpus to close to $500 million already. That is over 4,500 crores in excess of, in addition to what we already have deployed, which is 400 plus crores. So obviously, there's a huge amount of runway available with the capital available to us in the UAE markets. Plus, we've gone ahead and applied for additional new licenses in the DIFC, and we're hoping to receive that very soon. On the India advisory, we've added new assets. We've divested from legacy assets. We've got significant fees from all of them, as well as from our transaction advisory business in India. We've continued to have investments in the UAE and significant transaction advisory income also from the UAE. Our exits have created significant amount of continued confidence, not just now from domestic investors, but also global investors who are constantly now joining our fund pool in Mauritius, in GIFT City, and other pooling structures. As I shared with you, we're proud to be certified as a great place to work and one of the top financial institutions to do, and we recognize as one of the top financial institutions to do that. Friends, we're very significantly differentiated and poised for a unique growth story. We are uniquely the first listed fund manager in India. We're uniquely diversified in terms of products and geographies, as well as service lines and solutions. We have created great partnerships with domestic financial institutions, with global financial institutions, and global banks. We have a diversified range of capabilities, both in India and overseas, and we continue to tap emerging market opportunities. This kind of diversification, this kind of deep capabilities, this kind of unique positioning has been found of great value to global capital providers and global participants, including state stakeholders, regulatory authorities, both in India and overseas, who are actively engaging with us to find new solutions to their urban development challenges and vision. To report numbers, we've grown from 1,000 odd crores to 1,572 crores of AUM, which is a robust 55% growth, despite the last quarter headwinds that I described, where we were super cautious and investors were not keen to invest new capital, given that it was better to have a wait and watch approach and for the markets to play out. Our revenue, despite it being an IPO year, despite the last quarter being slower because of geopolitical headwinds, despite us not being able to employ most of our capital of the IPO, we were sitting on almost 67 crore rupees of cash from 101 crores raised as of March 25. Despite all these constraints, we have still posted a very robust revenue growth of over 56%, climbing to 67.3 crores of revenue, an impressive EBITDA growth, maintaining a very high EBITDA margin, as well as a respectable PAT margin in line with our guidance of keeping it close to 50% at all times. The PAT margins have risen by 35.5%, buoyed by effective tax regime, which is benefiting us in the UAE and GIFT City, where we have a 10-year tax holiday in GIFT City, bringing down the effective tax rate from over 30% to now nearly 22%. We continue to deliver high ROEs and ROC to our stakeholders on all our capital, increase our net worth, have a very respectable revenue to AUM ratio, which we've always maintained as being between 3.5% to 4%, and a very respectable price to book ratio and PE, as well as net asset value per share. So, despite this being a foundation year, despite this being a high capex year, despite this being a transformational year where we had to build new licenses, build new capabilities, build new teams, find new partnerships, we have still posted an extraordinary amount of strong results and outcome for all of us. And this is therefore now the quantum leap year for ourselves going forward. Next. In terms of business highlights, obviously to talk about industry snapshot, while the real estate industry has done well in terms of absorption of 4.7 lakh units, resulting in a decline in unsold inventory. However, the last quarter was marked by a little bit of slowdown, both in terms of absorption, in terms of inquiries, as well as new launches. So the last quarter of the last financial year marked a bit of caution now appearing within the RE sector, which has so far in the last 3 years have seen unabated growth and demand. We see that as a growing concern and trend, where while the industry will grow on a broad basis, on an overall, it will continue to grow, will need more capital, but the need to exercise caution is now higher than the last 3 years. We've seen the last quarter almost $15 billion of FI sell-off, which has erased a certain amount of market cap, and housing sales have dropped 23%. Obviously, in line with market, we've been cautious in the last quarter and stayed away from making any large commitments in the India markets. The UAE market, on the other side, however, has shown a very different trend. It was not faced with these sanctions and challenges, continued to rise 20% in volume, has today a $650 billion real estate base, continues to grow at 38% in number terms and 27% in value terms year on year, and has global capital chasing it in line with the 2040 master plan. We are one of the leaders today in a very short time, where a lot of deal flow, a lot of support from private and government agencies are today helping us bring out our potential and work our vision. AIF investments, of course, continue to grow. We have been one of the foremost AIF fund managers over the last 11 years, and there's been a lot of global interest in AIF pooling vehicles and manager track records both in India and GIFT City. AIF investments therefore have grown a robust 24%. Therefore, our fund pools expand, the capital committed to us expand, and ability to invest new capital expands as our AIF pools strengthen in investor interest, as well as our ability to deploy capital meaningfully into unique opportunities. The private credit space, of course, has also been on a very large expansive mode, with almost 76,000 crores being invested through private credit, and has been one of the strongest growth areas within capital markets and within financial services in the last 12 months. We see ourselves as one of the foremost leaders in private credit, focusing on urban infra, and therefore that remains a very unique opportunity for ourselves. To talk about, we're already aware we bought two buildings, new buildings. We're already in the process of selling and monetizing and exiting these investments. They will bring a huge amount of carry and upside for the investment manager, being us in the UAE. We have invested into very unique opportunities in India as well, of course, albeit with caution. We talked about our exits, and very proud with the exits we've achieved, very proud with the amount of accolades we've got from our investors, because of which global investors are now making a headway or a beeline for our funds, both in India as well as the pooling structures abroad. We invested into one of the first self-redevelopment projects and exited. We were one of the first to actually not roll over a debt with SP, but actually exited in about 12 to 15 months at 18.74 with a superior return, with one of the best timelines of exits, where others have chosen to roll over. We've divested from our Bangalore investments as well as from our Indore investments, and are making now new commitments to these markets in this financial year. These marquee exits have obviously stood as a testament and as a testimony to our ability to pick the right assets, keep a laser sharp focus on their performance, exit them, provide superior returns to investors, as well as book strong revenues and profits for ourselves. The pipeline remains really robust. We have locked in close to 1,000 crores of trades in India, very carefully curated over the last 6 to 9 months in cities like Mumbai, Pune, Bangalore, and Indore, which cover both performing credit as well as special sits, with a very sharp focus on risk management and returns and short-term turnaround, keeping the current situation of geopolitical, economic, and other macro situations in focus. We have also locked in today almost 1,500 plus crores of assets in the UAE, and these are Friends, in addition to what we already manage, if I add both of them, we're looking to add almost 2,500 crores of assets under management over the next 2 quarters, in addition to what we hold. We have the capital to do that. We have the asset pipeline to do that. We have the teams in place to do that. We have the structures to do that. And therefore, there's nothing that can stop these outcomes over the next few quarters. Just a breakup of the assets under management by geography, 29% being in the UAE and 71% being in India. We expect this to become 50-50 effectively by the end of this financial year. We've seen a robust 55% growth in that AUM. Next. To talk about financial highlights. As we mentioned, we've seen a 56% growth in revenue on a year-to-year basis. We've seen where there is no revenue coming from the UAE last year. We've seen our strong revenues coming from UAE, already forming almost 30% of our revenue segment. And of course, we were cautious, as I mentioned, on Q4, as well as we were trying to create structures, capex, infrastructure, and capabilities for this financial year and for the next 10 years, where a significant amount of bandwidth and a significant amount of efforts were being employed to create these platforms, which now have the opportunity to grow at a very, very rapid pace. Next. We've seen our margins expand, our profits expand from from 24 crores to 33 plus crores, a 35% growth, also which is supported by effective better tax rates. We continue to have a good EBITDA and PAT margin in line with our historic results. We have a robust AUM growth and continue to have a very strong now pipeline under closure. And obviously, we have invested a lot of capital in building our presence, in building our brand, in building our networks, in building our capabilities, which is now all culminating into a high value growth for ourselves in this year and going forward, which we'll share with you next. Of course, I'll let Sunil talk about the financials in a minute, but I will just quickly first close into what the growth story has been and will look like going forward. Next. Go back. Yeah. Just to talk about while we get into the numbers in a minute, we are proud to show that we've had a 73% CAGR growth over the last 3 years, and we project a similar or higher CAGR growth on revenues, on PAT, on EBITDA, year on year in this year and going forward, given what we are already looking to close and what we have already locked in our favor. A very strong AUM growth, a continued high ROE, ROCE, a very low leverage, and a very high margin on revenue to AUM. Next. I will continue to talk about the strategic outlook, and then I'll allow my colleague Sunil, our financial officer, to talk about numbers, strategic outlook. So obviously, as I mentioned, we were not able to utilize our IPO proceeds by the end of March. We got our NBFC approval very late from RBI, which is why the 25 crores allocation effectively went in only by the end of March. We could not use that money. We could not use a lot of the other capital, which is now getting fully deployed and fully leveraged for the purpose of high growth momentum and our business objectives. As you saw that we had almost 53% unutilized from Object 1, 53% unutilized from Object 2, and almost 100% unutilized from Object 3, leaving over 68 crore rupees from 101 crores sitting in the bank. We have been able to thereafter use that capital, partner with people, pay fees for bringing these investors and banks and stakeholders to ourselves, pay for having set up the licenses in all of these locations, and we're now ready to accelerate our businesses now that these are fully operational. Yes. The way forward is very important from my standpoint, and that's really what my job is to ensure that we stay on a growth path which is unprecedented, unabated, and absolutely sharp in terms of what we wish to achieve as a fund manager, as a leading financial services company in India and globally. From an AUM of 1572 crores, as I demonstrated to you, We're looking to lock in an AUM of 4,000 crores without taking additional efforts. Obviously, there's still a large runway in front of us, and there's a very high probability we may be able to exceed that. Our total AUM has generated over 4% in margins for us. While, of course, as the AUM expands, larger institutional investors join us, their propensity to pay large fees obviously diminishes. We're estimating it to still remain in the 3 and 3.5% AUM revenue to AUM range, therefore bringing a significant top line already to our balance sheet in this year, and while maintaining our PAT margins or exceeding it. Not only, therefore, are we on track to become a global asset manager with an AUM of over $1 billion by 2028, we're likely to actually prepone this event to even 2027. We have obviously been cautious in terms of new deployments in the last financial year, but we have made the right picks and we have focused on exits and given money back in the hands of our investors. We have deployed money across India as well as in the UAE. And now, as I described to you, we have a very strong locked-in pipeline of over 2,500 crores under closure for which we are fully capitalized. We continue to therefore drive very unique blue ocean strategies which provide a very high alpha to our investors, create very strong predictable revenue streams in our favor, as well as on exploiting unique opportunities across the capital stack, across geographies, across strategies, and with a very diversified capability and team strength. Obviously, as I mentioned, we have not been able to employ the entire amount of capital, but we've made significant investments. We've increased our balance sheet size. We've made significant capex investments in licenses, in people, in offices, in technology, in infrastructure, which is obviously what is going to get unlocked and leveraged in this financial year and beyond. We've got some of the largest global prominent investors who have now come on board with us, and very soon you'll see announcements about these partnerships of over 200 million potential dollars, which are joining hands with us in our global capital pool. We're very unique in that structure. Most people only have LP money. We have co-GPs. We have largest LPs. We have domestic capital. We have one of the most diversified capital bases potentially amongst any emerging market fund manager that I know of. We've scaled up our team. We're today now fully capable of delivering to our results and to our vision and to our AUM and to our stakeholders across geographies. Despite that, the revenue per employee is targeted to move from 1.5 crores to 2.5 crores or beyond. We have now today extraordinary capabilities to manage over $1 billion across geographies, across strategies, and while maintaining ourselves to be one of the best places to work, both in India and overseas, and be the top 5 as a great place to work as an investment house in India. We're very uniquely positioned, drawing extraordinary talent and retention of capabilities of human resources, across our offices. We have built a very robust network of 600 plus intermediaries. Today, we have every known intermediary, every known person working closely with us. We have built strong affiliation with institutional lenders and global investors. We have access capital through across the stack, from HNIs to family offices to institutions to banking networks who are today aligned with us. This unique capability, this unique infrastructure, this unique positioning, both in India and overseas, is what is creating a huge amount of upside and tailwinds in our favor. We're expanding deeply. We have created a strong origination and partnership ecosystem, and we are poised to grow unabated with the capital, with the infrastructure, with the network, with our recall in our markets year on year, with nothing stopping us. Therefore, exponential growth and strategic expansion is inevitable. We're unlocking opportunities very rapidly in our favor. We're poised to take off through inorganic and organic expansion opportunities as people come to partner with us every single day. I will.
Comparison between NISES and collective scale.
Yeah, okay. I'm usually okay. We'll talk about this later, but we will talk about the comparison. I'm usually asked what is NISES Finance, and of course, I think it's sometimes hard to understand what we are, because we're a very unique organization within the financial services space. We're one of the leading fund managers in India. We're today becoming one of the leading fund managers in UAE, with an opportunity to expand across the UAE, in Ras Al Khaimah, in Abu Dhabi, in Dubai, and in other Emirates. We've been invited and attended an event in Qatar We've been invited to partner in Qatar as well, with the Qatar Investment Authority, with the Qatar Financial Services Authority, and spreading our wings across the GCC. We've been invited to other emerging markets to do similar opportunities in urban infrastructure financing for them. So we're very uniquely positioned to capture and utilize our learnings from India while growing in Indian urban infrastructure and take those templates to global markets. We're again very uniquely positioned to have a very strong correlated advisory fee, where we're helping a lot of potential investing companies, a lot of stakeholders who come to us asking for a solution for capital, and we're able to do much better. We're able to monetize their assets. We're able to give them partnerships. We're able to create the right ecosystem for them and unlocking value for their asset pools and their balance sheets and restructuring them, therefore unlocking huge amounts of value in our favor. So obviously, and of course, we continue to earn huge margins because of the margins that we're delivering for our investors. We're delivering over 20% margins in India. We're delivering over 20% return, over 30% returns in the UAE. We have a significant amount of earnings coming from our AUM. We are very uniquely positioned in those aspects. We're very uniquely positioned to have partnerships not just with family offices or HNIs, but also global institutions, with core GPs, with domestic financial institutions, with global financial institutions, and with sovereign and bilateral institutions. And we're expanding that uniquely. So we partner, we have our own capital, we have the ability to work with multiple segments. And this is really what sets us apart, where we generate very strong revenue to AUM, which if I included our unaccounted carried interest, which you obviously can book and recognize only at the end of every fund life, we're today at almost about 6.7% of revenue to AUM. It's very unique from any other business model that you would have seen in any collective investment scheme or PIMS or mutual fund. We are not a constant distribution model, we're a partnership model. Our cost to distribution and fundraising is one of the lowest amongst peers, and we're able to utilize that very effectively by using third party capital and co invest models where we're able to earn a high AUM and high revenue in AUM without corresponding costs and losses. I'll now let my colleague Sunil take over on the financial performance for the next few minutes.
So, hi, good morning everyone, and thank you for joining us today. So, let's start with the financial result for the year, half year ended as well as the financial year ended March 25. So, looking at our revenue analysis, we stand at 67.3 crores in revenue, which is almost 56% YOY increase. And if you further bifurcate and compare H1 and H2 growth in financial year 24 and 25, so H1 25 saw a 180%, 184% increase in revenue from 12 to 38, 34 crores. And if we compare H2 25, we saw a 6% increase from 31 crores to 33 crores. So if I talk about our business segments, we operate under integrated model consisting of two core business segments. First is related to transaction advisory and second is fund and asset management. The revenue contributions currently stands at 67% from transaction advisory and 33 from fund and asset management. These two segments are highly complementary to each other. Further, strategically, we have diversified our business focus across two high growth markets, India and UAE. Notably, Dubai operation, which commenced in second half of the financial 25, contributed approximately 30% of to overall revenue. So, if I talk about during S2, we have observed a slowdown, promoting us to adopt a more cautious approach, which resulted in a YOY growth in half year stands at moderate 6% growth. For the year ended March 25, our EBITDA margins was 66% compared to 84% previous year. In absolute term, EBITDA grew by 22% YOY from 36 crores to 44 crores. And PAT has increased by 35 rising from 24 crores to 33 crores. So if I talk about why there is a dip in margin, so primarily it is if you see the expenses has been grown up, and if talk about the expenses, then employee benefit expenses and the other expenses has grown much larger. And why these has been increased? So we have expanded our operations both domestically and internationally. Effectively, now we have doubled our employee strength from 22 to 44, 22 to 44 employees. And even we have established our new offices in Dubai and India, which has increased our rent and other expenses, other overheads. Additionally, during the IPO and because of the new office in Dubai, we have expensed more in branding and marketing expenses throughout the H2.
Just to explain this number that you see in front of you, where our employee cost has gone up from 10 to about 11 crore rupees, which is obviously the core engine of growth, is the talent pool and capability that we built. Our finance costs have actually remained muted or low. We have obviously added new offices both in Mumbai, in Gift City, in Dubai, which obviously, as well as if you see the depreciation amortization amount has gone up because we've invested a significant amount of money of close to about 20 crore rupees into assets, into licenses.
Yeah, for fundraising and book.
Right. We've invested almost 20 crore rupees into creating the infrastructure which I talked about, the partnership with global banks, the distribution, the offices, the licenses across UAE, across Gift City, across India. And a lot of these expenses have obviously, gone to capital, which are going to get amortized over 7 years. When you amortize that amount over 7 years, you'll obviously have an amortization expense. And then there were extraordinary items. So obviously we have not carved out extraordinary items, which is the branding, our positioning, our IPO expenses, which could not be, which are not adjusted in capital, as well as some of the other non-amortizable expenses related to our investments in creating that infrastructure. We cannot capitalize everything. We have a lot of legal expenses we had incurred. And these are all extraordinary in nature. So if I were to consider almost about 4.5 crore rupees of this is extraordinary in nature, which means the recurring expenses being more 7-8 crores, which is largely to do with the events that we do, the travel that we do, the outreach that we create across offices, with us being present in multiple geographies. That's the expense that obviously goes into paying for our advisors. We've got some of the best advisors in the world who sit on our board, both in India as well as in the UAE, and we pay for that. So the recurring nature is more in the nature of, in my mind, 8 to 8.5 crores, the rest being more extraordinary. So we do not expect now this number to grow by any material amount, whereas obviously the revenue impact is where we're going to see, thereby directly flowing into our PBT and PAT going forward as the revenue from UAE accelerates and the AUM balances out to almost 50-50. We will have additional benefit of tax saving. So we're likely to go from a current 22% effective tax rate to maybe 18-19% tax rate as well in this current year. Obviously, these are benefits that are getting unlocked because of what you see in terms of the infrastructure getting created, which are obviously getting amortized on our P&L without the corresponding revenue hitting this year, which will obviously start coming in the current financial year. It did not obviously come in the last year, but the capex came in, the amortization cost came in. Balance sheet.
Yeah, so if I talk about the balance sheet, so we have successfully listed in BSE in December 24. So our shareholder fund has increased from 33 to 160 crores. So as a result, our shareholder so this is IPO funds were related to against this we have raised 101 crore from IPO, and rest is related to our accruals. And if you see our non-current investment has increased, so these which primarily represent our sponsor capital, which we have deployed in various funds. So and chunk of the money is invested in our Gift City fund, which is feeder fund to our Dubai fund.
Important point to note, friends, is that if you see our borrowing is only 6.82 crores, which has gone to 8.32 crores, let me point out to you that this is my money. There are no external third-party borrowings. Whatever money I got net of tax from offer for sale, I've invested back into the company. My commitment to Nisus Finance as an enterprise is more than 100%. Not only are we present as promoters, as family behind the company, but also 100% of our capital remains deployed. Any money received from off of a sale post-tax has also gone back to the balance sheet. This is only a reflection of what Nicest Finance means to us, to me, and to all of us as a team. We're mindful of this. We continue to put not only our time, our hearts, our souls, but our capital and our family's futures behind the company. You've seen that our non-current investments have gone up significantly. The 20 crores which I talked about, 19.28 crores, is exactly what we've invested into our distribution, into our partnerships, into a license, which is obviously getting amortized, which is where the effect of amortization has been seen on the balance sheet. That's a very important infrastructure we've created to create the opportunity set and make these global funds, investors, banks now start working to us, having created significant credibility and presence in our markets. Next. We've already talked about the growth in CAGR. Okay, friends, thank you very much. I think just to put in perspective, a lot of people have asked me, how do you describe your your business ratios? Obviously, the way of classifying it in accounting has been different in FY24, where we club revenue from transaction advisory fund into one segment and other income into other segment. We've now bifurcated that and redefined that in this current year as segment one being revenue from transaction advisory and segment two being revenue from fund management and other income. So please do not get confused about what the ratios are, because this is the true representation. It's only an accounting classification. So if I have to put it back into this definition, you will see that we still maintain a 1/3, 2/3 ratio between transaction advisory and fund management. This is likely to grow in favor of fund management as the corpus increase. As we go to 4,000 crores of assets under management this year, this is likely to be more like 40-42%, with advisory being about 60%. If you see the growth on transaction advisory revenue, we've had a very robust 49% growth YOY on transaction advisory, and even a higher growth on fund and asset management because of the launch of the UAE fund of 73% YOY, bringing the overall growth to about 57%. It's a very impressive track record, friends. Please believe me, it's very hard to have achieved what we've achieved last year, despite the headwinds, despite not being able to put our IPO money to work, despite being in a new geography. We have achieved something which is truly exceptional, and we are poised to deliver exceptional value to ourselves and to all our stakeholders year on year, including this year and going forward.
Thank you everyone for joining the call of Nicest Finance Services Co Limited. Any other queries, you can write us at research@kirinadvisors.com. Again, thank you everyone for joining the conference. Thank you.
Thank you so much. Thank you. Thank you so much for.
Yeah.
Thank you.
Chalo. Bye.